Welcome back to the Deep Dive. Today we're tackling a company that I think creates a lot of confusion for investors. It's Assurant Inc., ticker AIZ.
It really does.
And for the kind of critical investor we're speaking to here, the one who's really looking for those deep, verifiable moats and, smart capital efficiency, AIZ is a bit of a paradox.
It is. On the surface, it looks like a pretty low-growth specialty insurer. It's got that financial services label slapped on it. And for many, that's reason enough to just move on.
Exactly. You just put it in a certain box and don't look any closer.
And for the high IQ investor, that label should be the first thing you question. So our mission today is really to just strip away that assumption entirely.
Okay.
We've gone through the sources, we've looked at the structure, the capital, the real risks. And our goal is to figure out definitively, is AIZ just another run-of-the-mill insurer that relies on leverage?
Or is it something else entirely?
Or is it this stealthy industrial compounder in disguise, a kind of hybrid tech and logistics firm whose real value is just being fundamentally misunderstood?
So that's the core thesis we're setting up right from the start. The uninsurance company. We have to look past this specialty insurer name.
Yeah, have to.
Because even though they hold the licenses, the business model itself is really a B2B2C model. Business to business to consumer.
Right, and that's a critical distinction. They are not out there trying to win over individual consumers with ads. Their business is about becoming this invisible but absolutely essential infrastructure partner.
For who?
For massive global brands. Think T-Mobile, think Amazon, think Wells Fargo. They're the engine behind the scenes.
That invisibility is such a key point. They're not underwriters in the traditional sense. It's more like they're these incredibly sophisticated tech-enabled risk managers and logistics handlers.
That's the perfect way to put it. The insurance premium at the end of the day is just the financial vehicle. It's how they monetize this incredible infrastructure and the mountains of proprietary data they collect.
So they're taking on the operational complexity that their huge partners just don't want to deal with.
Exactly. Device refurbishment, overnight shipping for a replacement phone, the incredibly complex compliance needed to track millions of mortgage insurance policies. T-Mobile doesn't want to build that. Wells Fargo doesn't want to run that. Assurant does.
Okay, let's unpack that operational advantage right away. And I want to start with their most unique feature, what you've called the structural hedge. This is the counter-cyclical negative beta piece of the puzzle that really makes AIZ stand out.
It's what makes them so fascinating from a portfolio construction standpoint. This company is, it's almost designed to thrive under economic stress.
And that resilience is anchored in one specific segment.
It is. It's primarily in their global housing segment, and even more specifically, a product called lender-placed insurance, or LPI. Most companies, when the economy tanks, their revenue and earnings shrink. AIZ has this built-in mechanism where a recession can actually boost their high-margin revenue.
Okay, so walk us through that trigger mechanism. For an investor who isn't familiar with the nuts and bolts of mortgage servicing, how does this actually work?
So the mechanism is tied directly to borrower distress. Let's say a homeowner, maybe they've lost a job, or adjustable rates have reset higher. They're feeling the pinch.
Right.
One of the first things they might stop paying, if it's not escrowed, is their hazard insurance premium. But the bank's collateral, the house itself, is now unprotected.
So the bank has to step in.
The bank has the right, it's in the servicing agreement, to force place an insurance policy on that property to protect its investment. That policy is LPI. And because Assurant is the outsourced agent tracking over 30 million of these loans for the big banks, they're the ones who see the lapse in real time.
So the very conditions we associate with a downturn, rising unemployment, higher delinquencies, a deteriorating credit cycle, those are the exact same conditions that trigger a spike in high-margin LPI revenue for Assurant.
That's the internal hedge. It is a textbook, a perfect example of negative beta. Consumer spending might slow down, which could soften their global lifestyle segment a little bit. But the housing segment just steps up and provides this incredible earnings resilience. That kind of structural protection is not something you're going to find in a pure-play tech company, and you won't find it in most traditional P&C insurers either. It puts a real floor under their earnings.
And this isn't just a theoretical model. We have recent data that proves this out. The Q3 2025 performance really highlights this structural strength.
It was a massive confirmation.
They reported adjusted earnings per share of $5.73. That didn't just meet expectations. It completely blew them away. The consensus on the street was 432. That's a 33% surprise.
That Q3 number should have been a screaming signal to the market that this hybrid model is working exactly as designed. Total revenue hit $3.23 billion, but you have to look at where that surprise came from.
Like, the breakdown is key.
Global lifestyle, the growth engine, it provided steady, respectable growth, about 6.8%. But global housing surged 16.2%. And that surge in housing confirms two critical things for us. First, it shows they have pricing power. They are successfully passing through premium increases because of inflation and climate risk. And second, the underlying dynamics of financial stress are starting to kick in, accelerating those LPI placement volumes. It confirms the negative beta thesis in real time.
So you've got this company with built-in recession resilience, strong EPS growth that's supercharged by buybacks, and clear evidence of successful execution. And yet, the market, as of late 2025, is still pricing it pretty conservatively.
It is.
You're looking at a PE of around 14.7 and a price-to-book of about 2.1.
And that's the core of the valuation opportunity we're looking at. For a business that is aggressively shifting its revenue mix toward capital-light, fee-based services.
Services that should command a much higher multiple.
They absolutely should. In the logistics or payment processing space, you'd expect multiples north of 20 times earnings. A 14.7 PE implies a significant discount. The market is still viewing AIZ through that old P&C insurance lens.
Which means lower multiples because of volatility and capital intensity.
Right. So the opportunity for the investor is to recognize that AIZ is being priced like a high-quality specialty insurer, but it's increasingly operating like a capital-light industrial compounder.
Okay, let's move into the operational deep dive. We'll dissect what you call the bifurcated engine. And we have to start with global lifestyle. This is the main vehicle for their long-term organic growth.
It is. Global lifestyle is absolutely critical because it represents the future quality of their earnings. It's their biggest segment by revenue, about $2.5 billion in Q3 2025, and it's where the highest growth potential lies, especially in connected living and the whole mobile device ecosystem.
Let's focus really hard on connected living, because this is where that logistics moat you mentioned earlier really comes to life. This is so much more than just simple underwriting.
It is.
So walk us through it. Operationally, what happens when I, a customer with T-Mobile Protection 360, file a claim because I dropped my phone?
The second you file that claim, Assurance Machine kicks into high gear. And it's a massive, vertically integrated logistics chain. This isn't just some paperwork shuffle where they cut a check.
Right, it's physical.
It's intensely physical. Assurant is managing the movement of millions of physical units every year. They handle the overnight replacement shipping. They own the inventory. They own the distribution centers needed to meet that promise. They have this huge, sophisticated repair network, nearly 500 physical locations.
And it's not just people with screwdrivers.
No, more importantly, they have these automated facilities using robotics for high-volume repair and refurbishment. It's a massive capital investment.
So a pure-play underwriter, a company that just wants to take on the risk and collect a premium, they couldn't even begin to compete with this model.
They absolutely could not. A pure underwriter would have to outsource all that to third-party logistics firms. And that would, it would destroy their quality control, it would slow down the turnaround time, and it would completely erode their margins. Assurant's ability to manage the entire chain repair, refurbishment, replacement, even sourcing specialized parts and using robots to test thousands of phones an hour, that is a massive, non-replicable operational moat. It's what separates them from any traditional insurance competitor.
And this whole logistics capability is what enables the trade-in economy. And that part of the business is growing even faster than the protection product itself, right? Especially with flagship phones now costing well over $1,000.
The trade-in economy is critical. It puts Assurant right in the middle of a carrier's two biggest challenges: customer retention and upgrade cycles.
So when I go into a T-Mobile store to upgrade my phone,
Assurant is the engine making that transaction happen. Their system, in real time, adjudicates the value of your old device. It instantly issues the credit to T-Mobile at the point of sale. Then they manage the secure processing of that old device, and then they handle the resale into the secondary market somewhere in the world.
that real-time valuation, that's an incredible advantage. The scale must be enormous.
The scale is staggering. In Q3 2025 alone, just one quarter, Assurant reported that they returned a record $1.59 billion to consumers through these trade-in programs.
$1.5 billion in one quarter.
Yes. And that number really highlights their role. They are essentially the global liquidity provider for the used device market. They're taking on both physical and financial risk on millions of devices, and they're monetizing their expertise through efficient logistics and, crucially, superior data on residual values.
Okay, now let's connect this back to our main valuation thesis. This segment is driving a really fundamental shift in their financials towards service income.
This is the high-quality earnings shift that you as an investor have to focus on. As these trade-in management fees, logistics fees, servicing fees grow, the proportion of their revenue that comes from pure, volatile underwriting premium shrinks.
And service fee income is just structurally better.
It's structurally better, it's less capital intensive, which means it requires lower regulatory capital reserves, and it's significantly less volatile than underwriting income, which, can be wiped out in a bad quarter. This improving revenue quality is the #1 argument for why the market should eventually re-rate AIZ to a higher valuation multiple.
Okay, let's move to the other half of global lifestyle. Global automotive. This is vehicle service contracts, VSCs, and GAP insurance, sold mostly through car dealerships. And the big strategic move here was that 2018 acquisition of the Warranty Group, or TWG.
The TWG deal was absolutely transformative. It was a $2.5 billion acquisition, and it instantly doubled the size of their auto business. More than that, it gave them a huge international footprint, pushing them into over 35 countries.
So this is all about scale.
It was about securing global scale and market access. But, and this is a critical point for our investor audience, we have to note that this acquisition added a huge amount of goodwill to the balance sheet, about $2.6 billion.
And that's going to come back to haunt us later.
It's the source of one of the major distortions we need to dissect when we get to the return on invested capital debate. It's a crucial piece of the puzzle.
Now, unlike connected living, which you can see as this clear secular growth story, the global automotive segment is much more cyclical, much more sensitive to the broader economy.
Significantly more sensitive. VSC sales are tied directly to new and used car sales volumes. So when people stop buying cars, Assurant's revenue pipeline in this segment slows down immediately.
But it's not just sales volume, it's inflation too.
The margins in this business are brutally exposed to external inflation. The cost to repair a car is all parts and labor. And if those costs, shoot up faster than Assurant can get their premium adjustments approved by regulators, their margins get squeezed hard.
And we saw that play out in a big way during the inflationary spike of 2022 and 2023.
We did. It was a perfect case study. Margins compressed severely because there's a pricing lag in the highly regulated VSC market. They couldn't just jack up their premiums overnight to match the skyrocketing cost of an alternator or a technician's hourly rate.
But they did eventually recover.
They did. The margin recovery we saw in late 2025 confirms that they do have pricing power. It just operates with a regulatory lag. So this segment gives them scale and diversification, but it's one where you absolutely have to keep a close eye on inflation trends and auto sales data.
All right, now we pivot from the growth engine to the counter-cyclical fortress, global housing. This LPI engine is the cash cow. It's what provides the stability and that unique hedge we talked about at the top.
LPI is often called the hidden hedge for a good reason. And Assurant's primary function here, their moat, is acting as the sophisticated, outsourced tracking agent for these enormous loan portfolios. Just for context, they are managing the insurance status of over 30 million loans for some of the biggest mortgage servicers in the country.
So how does that tracking function become a competitive advantage? I mean, why can't a big bank just do that themselves in-house?
The administrative and compliance burden is just immense. Imagine trying to track 30 million loans across thousands of different local insurance carriers, jurisdictions, policy types. It requires this incredibly complex 24/7 IT platform that has to plug seamlessly into the bank's own core servicing systems.
And then there's the regulatory risk.
Which is unforgiving. If a bank misses a lapse or if they fail to send the exact regulatorily compliant sequence of warning letters before they force place a policy, they are looking at massive fines and lawsuits.
So it's easier to just outsource it.
Banks are more than happy to outsource this necessary, complex, and high-risk administrative burden to a specialist like Assurant who has the scale and expertise to do it right.
And as we've already laid out, that deep operational integration is what generates the countercyclical profits. Let's just reinforce that negative beta characteristic one more time with specifics.
When economic stress goes up, leading to more mortgage delinquencies and insurance lapses, the placement volumes for LPI surge. The beauty of this business is that the customer acquisition cost is basically zero.
The business just comes to them.
It comes automatically through the tracking contract. And the product itself is very high margin. So what does that mean? It means that when the stock market might be crashing and other financial companies are getting hammered, Assurant's global housing segment is providing this essential high-margin buffer that reinforces their overall earnings floor.
And the profitability numbers from that segment really tell the story. That 70.2% combined ratio they reported in Q3 2025, that's exceptional.
A 70.2% ratio is incredible. It means that for every dollar of premium they collect, only about 70 cents goes out to cover claims and expenses. That leaves nearly 30 cents as pure underwriting profit.
That's a huge margin.
It's a truly impressive margin, and it confirms the extremely low customer acquisition costs and the pricing power they have in this non-competitive LPI market. But, and it's a big but, we have to carry the caveat that this segment is inherently volatile because of its exposure to catastrophic weather events.
All right, we'll get to that in the risk section. But before we leave housing, we should briefly touch on the multifamily and renters insurance piece. It's a quieter part of the business, but it's an important growth driver.
It is, and it's a textbook example of a capital-light distribution model. Assurant partners with big property management companies and tech platforms to distribute renters insurance. They often integrate it right into the online lease signing process.
So it's all about distribution, not risk-taking.
Mostly, yes. It's a high-volume business that leverages the big secular trend of more people renting. A lot of the actual risk is reinsured out, which makes this predominantly a fee-based service revenue stream. It's an administrator and distributor. It's clean, it's recurring, and it's very valuable from a valuation standpoint because it's so stable and doesn't tie up a lot of capital.
Okay, so we've dissected the business. Now we move to the really rigorous assessment of their competitive advantage. For that high IQ critical investor, the question isn't just, is this a good business? It's, can this business be disrupted? Let's analyze the economic moat.
The moat here is deep, but you have to understand it's entirely non-traditional. It's not built on brand loyalty or having the lowest price. It's built on inertia, on operational complexity, and on data superiority. We'd categorize it as a narrow to wide moat, and it's anchored primarily in extremely high switching costs.
You've called this the spaghetti code effect. Can you make that concept really concrete for us? Give us a hypothetical scenario.
Okay, sure. Imagine you're the chief information officer at a huge U.S. bank. You manage a portfolio of 6 million mortgage accounts, and you've been using Assurant for your LPI tracking for a decade.
Okay.
Every single one of your core servicing systems, your loan origination platform, your accounting systems, your compliance reporting tools, all of it has been integrated line by painful line with Assurant's APIs over the past 10 years. It's a mess of spaghetti code.
And now a competitor comes along.
A competitor comes in and offers you a 5% cheaper premium rate. To get that 5% savings, you have to migrate 10 years of historical data for 6 million loans. You have to remap hundreds of complex compliance rules across 50 states. You have to run a parallel system for months just to test the transfer. The estimated cost, the time, and the regulatory risk of that migration would absolutely dwarf that 5% in savings.
So the operational risk of a failed transition, which could lead to millions in fines, or just a massive service disruption for your customers, it far outweighs any potential cost benefit of switching.
Absolutely. The status quo is so deeply entrenched and it's protected by that complexity, and that leads to new bulletproof retention rates in the LPI business.
And you're saying the same principle applies in the mobile space with T-Mobile.
It's the exact same principle. Assurance systems are hardwired directly into T-Mobile's point-of-sale systems in their retail stores. If you unplug that infrastructure, you would paralyze T-Mobile's ability to offer instant trade-in credits. It would disrupt their inventory management, their claim servicing. It would grind their core retail operation to a halt. This isn't just a simple contract. It's an indispensable operational partnership.
So that's the switching cost piece. Let's talk about the intangible assets, specifically the proprietary data moat that gives them what you call actuarial superiority.
Their data is, frankly, priceless, especially in the housing segment. Assurant has spent decades collecting historical data on incredibly granular metrics. We're talking lapse rates, reinstatement speeds, foreclosure correlations, and loss ratios.
Down to what level?
down to the individual ZIP code and loan type across multiple full economic cycles. No one else has that data set.
Why is it so critical? I mean, couldn't a well-funded startup just come in and try to replicate that?
They could try, but it would take them decades, and they would almost certainly fall victim to what's called the winner's curse.
Explain that.
A new LPI entrant would have to price their risk based on generalized public data. They'd be underwriting blindly for years. They'd likely win business by underpricing it, exposing themselves to the potential for absolutely catastrophic underwriting losses if they misjudge the risk pool. Assurant knows with incredible precision which properties are low risk, which are high risk, and what the loss ratio should be in a specific market under specific economic conditions. It's how they can consistently price for that 70% combined ratio.
And this data advantage extends into connected living with their residual value data.
This is their secret weapon in the trade-in business. Assurant processes millions of devices every year. iPhones, Samsungs, tablets, watches across hundreds of thousands of different SKUs globally. This gives them real-time proprietary visibility into the true, liquid, secondary market value of all these devices. They know what a 2-year-old iPhone 25 in fair condition is worth in Brazil versus Germany.
Which means?
It means they can give the most optimized, most accurate trade-in offer to the carrier. T-Mobile relies on Assurant to know that the device they are taking in today can be refurbished and resold tomorrow for a guaranteed price. This ability to optimize reduces risk for the carrier, and it guarantees Assurant their margins on the refurbishment and resale. It's a huge information asymmetry that a competitor just can't replicate overnight.
We should also touch on the cost advantage that comes from their sheer scale. And this spans both the physical logistics and their financial purchasing power.
Scale drives two major cost efficiencies. First is what you could call logistics network efficiency. Because they're handling such an immense volume of physical devices, they can justify the huge capital investments in automation and robotics in their refurbishment centers,
which lowers their cost per unit.
It drives down the unit repair cost, making their operations structurally cheaper than any smaller competitor who's trying to manage the same level of complexity. The second piece is their reinsurance purchasing power. Assurant is one of the biggest buyers of catastrophe reinsurance on the planet, and that massive volume allows them to go to the reinsurers and demand better terms and better pricing. So they effectively lower their net cost of assuming catastrophic risk compared to smaller rivals.
Now, if we look at the competitive landscape, particularly in mobile protection, it really looks like a stabilized duopoly. You have Assurant focused on the B2B side, with T-Mobile as their crown jewel, and then you have Assurant, which is dominant with Verizon and AT&T.
And that duopoly structure for an investor is a gift. When you have two major entrenched players, and both of them are protected by these prohibitively high switching costs, the market dynamics tend to be very rational.
Meaning rational pricing.
Rational pricing and stable high margins. They compete like crazy to win these large exclusive carrier contracts, but you don't typically see them engaging in these destructive retail price wars that would just erode profitability for everyone.
But doesn't that duopoly structure inherently expose Assurant to the risk that a competitor like Assurant decides to just throw rational pricing out the window to win that massive T-Mobile contract, no matter the cost? Is that stability really sustainable?
That is the perennial risk. It's exactly why we label the T-Mobile concentration a binary threat later on. But you have to remember that Assurant is also a rational economic actor. They know that if they destroy their own margin structure just to win a contract from Assurant, a contract that's deeply woven into T-Mobile's infrastructure, it would set a very dangerous precedent. It would damage the pricing environment for their own established profitable contracts with Verizon and AT&T. The switching costs are a huge deterrent to that kind of aggressive margin erosion.
One final point on the moat before we hit the financials. Let's talk about brand equity. You've made the case that Assurant being a white label provider is actually a strategic advantage.
I believe it is, absolutely. The consumer has no idea who Assurant is. The brand on your protection plan is T-Mobile or Amazon, and this B2B focus means Assurant completely avoids channel conflict.
They're not competing with their clients.
They are purely an enabler, a trusted partner whose success is 100% tied to the success of their client. Their brand equity isn't with you, the consumer. It's defined by their reliability and their integration capability in the corporate boardroom, which is exactly where it needs to be.
Okay, let's pivot to the financial deep dive. This is where we need to separate the casual analysis from the rigorous scrutiny that a high IQ investor demands. Let's start with revenue quality and their capital allocation strategy.
The financial story here is one of moderate but very high quality growth. We're looking at about a 7% compounded annual growth rate in revenue from 2022, when it was around 10.2 billion, to the late 2025 trailing 12-month figure of about 12.6 billion.
Steady, predictable expansion.
It is. But the crucial story, as we keep saying, is the shift in the quality of that revenue.
Right.
The accelerating growth of that connected living fee structure, the logistics fees, the trade-in fees, the service fees. It means that a much greater proportion of that 12.6 billion is less exposed to the shocks of underwriting volatility. This fee-based recurring revenue deserves a premium valuation multiple, and that's what should push their blended PE higher over time. The quality improvement is the main lever for valuation expansion.
And their capital allocation strategy is famously aggressive. They've earned the nickname the cannibal for a reason. Explain how they return capital to shareholders.
Assurant has one of the most shareholder-friendly capital return programs in the entire sector. Since their IPO, the company has bought back approximately 66% of its outstanding shares.
66%. That's an enormous reduction.
It's a huge reduction in the share count, and it's a powerful signal of management's conviction that their stock remains undervalued relative to its intrinsic growth and earnings power.
And we saw them double down on this just recently, in late 2025.
They are relentlessly opportunistic. In November 2025, they got authorization for a fresh $700 million share repurchase program. This cannibal strategy is a massive accelerator for EPS growth. Even if the underlying business, the top line, only grows at 5%, management can use these buybacks to boost EPS growth well into the double digits. It's an aggressive way to compound shareholder value.
And for the more conservative, income-focused investors in our audience, the dividend track record provides a lot of stability here.
Absolutely. They have the official status of a dividend achiever, which means they've increased their dividend for 21 consecutive years, and the payout ratio is incredibly safe. It's under 20%.
So the dividend is secure.
The dividend is very secure, even in a severe recession, and there's a ton of room for it to continue growing at a double-digit rate. It's a really compelling mix of growth acceleration through the buybacks and stability through that growing dividend.
Okay, now let's tackle the intellectual heart of the financial analysis for this company. The deep discrepancy between return on equity, ROE, and return on invested capital, or ROIC. This is the metric that trips up a lot of traditional investors.
This is where we have to be extremely rigorous, because on the surface, the numbers look like they contradict each other completely. The trailing 12-month return on equity is very healthy. It's about 15.7%. That suggests they're using shareholder capital very efficiently.
But then you look at the TTM return on invested capital, the ROIC, and it's alarmingly low. It's around 3.08%, which is way below any reasonable estimate for their weighted average cost of capital, their WACC, which we'd peg around 8%.
Right. So the raw ROIC figure suggests this company is actually destroying value with every dollar it invests.
And that's where the deeper analysis comes in.
This is precisely why context is king. We have to understand the fundamental distortions that are inherent when you apply a standard industrial company ROIC calculation to a hybrid insurer that has grown through a major acquisition. There are two critical distortions that are mechanically pushing that number down.
Okay, let's break them down. Let's start with the first distortion, the float.
Standard ROIC calculations define invested capital as the sum of all the debt and equity that a company uses to fund its operations. But an insurance company gets to use something called the float.
The premiums collected before claims are paid out.
Exactly. It's the investment portfolio that's funded by prepaid premiums and loss reserves. This float is technically a liability on the balance sheet, not permanent capital, and it is essentially cost-free money.
So if you include that float, which is generating investment income for the company, in the denominator of the ROIC equation, what's the effect?
If you include that giant pool of cost-free liabilities in the denominator, you are artificially inflating the invested capital number. The resulting ROIC figure gets mechanically driven way down, making the company look far less capital efficient than it actually is. A normal industrial company has to raise debt or issue equity to fund its assets. An insurer gets to use its customers' money for free to fund a big chunk of its balance sheet. ROIC, in its raw form, penalizes this unique and advantageous capital structure.
Which brings us to distortion number 2, goodwill. And this ties directly back to that 2018 TWG acquisition we discussed earlier.
It does. That deal put approximately $2.6 billion of goodwill on Assurant's balance sheet. And goodwill is just the premium they paid over the fair market value of the assets they acquired.
And by accounting rules, that goodwill gets included in invested capital.
It does. It sits there as this intangible, non-depreciating asset that inflates the denominator of the ROIC calculation by billions of dollars. It's a huge reason why that ROIC percentage looks so unappealingly low, down at 3%.
So the final takeaway for our critical investor is clear. For this specific company, raw ROIC is an unreliable and, frankly, misleading metric.
It is. The sophisticated investor should basically discard the raw ROIC figure and focus instead on the metrics that truly measure value creation. That's the robust ROE of 15.7% and, just as importantly, the growth in book value per share.
And how has that been trending?
The fact that book value per share has been compounding at an incredible 16.1% annually over the last 2 years is all the proof you need. It confirms that management is creating significant, repeatable shareholder value, even if the distorted ROIC figure doesn't show it.
Before we move off financials, a quick governance check.
Yeah.
How are management's incentives aligned here, and does that alignment reveal any potential weaknesses?
Management's compensation is heavily tied to the company's financial performance. About 80% of their incentive pay is weighted toward 2 metrics, adjusted EBITDA and NOI EPS. So they're incentivized to grow earnings.
But the critical governance note for us goes back to our ROIC discussion.
It does. The fact that ROIC is not a primary short-term incentive metric is a potential governance weakness that we need to monitor. Management is paid to grow EBITDA and EPS, but the explicit lack of an ROIC target could inadvertently incentivize growth for growth's sake.
Potentially leading to capital accumulation that isn't strictly efficient.
Right. It could reinforce that goodwill distortion over time instead of prioritizing absolute, strict capital efficiency. It's not a fatal flaw by any means, but it's a slight misalignment of focus that's worth keeping an eye on.
All right, let's turn the corner and look at the critical risks and challenges. The skeptical viewpoint is essential here. We need to dissect the potential downsides and the binary threats to this entire thesis.
And the single biggest, most immediate, and potentially catastrophic risk is, without a doubt, client concentration. We call it the T-Mobile factor.
Right. We've established T-Mobile is material to the revenue of Connected Living, which is the company's whole secular growth engine. Losing that contract to a competitor like Assyrian would be, well, catastrophic.
It is the ultimate binary risk. If that relationship were ever severed, the growth thesis for the entire company would be severely damaged. The valuation would probably collapse overnight, back to that of a boring, slow-growing traditional insurer. But as critical investors, we also have to look at the mitigants.
We know the contract was renewed in 2022 for a multi-year term, so that gives some medium-term visibility. But what specific operational signs should an investor watch for that might signal T-Mobile is thinking about making a change?
You should monitor 2 things very closely. First, look for any news about changes in the stickiness of the partnership. Assurant has been deeply entangling themselves by actually running repair centers directly inside T-Mobile's physical stores. That's a huge logistical investment.
So a red flag would be
any move by T-Mobile to bring those operations in-house or to transition those in-store repair logistics to a competitor would be a massive red flag. It would signal a deep-seated intention to eventually switch providers. Second, you have to monitor service satisfaction metrics. The main reason a carrier stays with Assurant is the quality and speed of claim fulfillment. Any sudden drop in Assurant's operational performance is the crack in the armor that Assyrian would rush to exploit.
Okay, the second major threat comes from regulatory headwinds. We've called this the LPI ghost, and it specifically haunts that highly profitable global housing segment.
LPI is, and always will be, structurally vulnerable to regulatory scrutiny. And that's because of its forced nature. This is a product that is mandated upon a homeowner who has zero choice in the provider or the price. And it's often happening precisely when they are in the most financial distress.
So consumer protection agencies are always watching it.
They view this market structure as being ripe for potential abuse, which means they demand constant vigilance over pricing and practices.
And there's a clear historical precedent here. We can look back to the 2013 settlement over the practice of reverse competition.
Correct. Reverse competition was a systemic problem where LPI insurers were essentially giving kickbacks or other financial incentives to the banks to secure those exclusive tracking contracts. The banks benefited, and the consumer, who was trapped, ended up footing the bill through inflated premiums.
Just so we're crystal clear for the listener, Reverse competition basically meant they were paying a kind of bribe to the bank, and the vulnerable homeowner paid for it. Is that the gist of the complaint?
That is the essential outcome from the consumer's perspective. The actual mechanisms were more complicated, of course, often involving sophisticated reinsurance sharing agreements, but the result was the same. The consumer was penalized by the lack of competition. That history means LPI is perpetually in the regulator's crosshairs.
So given the current high interest rate environment and the potential for rising foreclosure rates, this regulatory threat has to be considered active and material right now.
Absolutely. If we see financial stress and foreclosure volumes really start to tick up, you can bet that regulators will start focusing on LPI premiums again. The biggest risk here is a regulatory cap on rates, or what's called a loss ratio minimum.
What would that do?
If a state regulator comes in and imposes a mandatory rate reduction or demands that, say, 65% of all premiums must be returned to policyholders as claims, it would directly crush the high margins of that 70% combined ratio segment. It would basically eradicate the company's internal recession hedge and severely impair their overall earnings power.
Okay, let's move to the last critical risk, catastrophe exposure and the impact of climate change. We know global housing is profitable, but it's also inherently volatile.
Volatility is the price you pay for that 70% combined ratio. Catastrophe losses are a real and recurring part of the business. We saw this starkly in the third quarter of 2024, where a major storm event caused net income to drop 30%, almost entirely due to cat losses.
But they have protection for that. Describe the reinsurance tower mechanism they use and their current retention levels.
Assurant has a very sophisticated reinsurance program that's designed to limit their financial exposure from any single major event. Their current retention, which is effectively their deductible, is capped at around $150 to $160 million per catastrophic event.
So they pay the first one $60 million.
They pay that first amount, and then the global reinsurance market picks up the rest of the tab, typically covering losses up to nearly $2 billion. This puts a hard cap on their financial downside from a single massive hurricane or earthquake.
But climate change is altering the nature of the risk. It's driving more frequent secondary perils. We should define that term clearly for our investor.
Secondary perils are those weather events that aren't the huge, headline-grabbing named hurricanes. They're becoming much more frequent and much more severe. We're talking about large-scale hailstorms, unexpected inland flooding, and clustered tornado outbreaks. These smaller, more frequent events often fall below the attachment points of the biggest, most cost-effective reinsurance layers.
Which means Assurant ends up absorbing more of the loss themselves.
They do. And this leads directly to what's known as the reinsurance squeeze.
Explain what an attachment point is and how the reinsurers are squeezing Assurant.
The attachment point is just the threshold, the deductible, at which the reinsurer starts paying. If Assurant's retention is $160 million, that's their attachment point. Because of the rising frequency of these secondary perils, reinsurers are now raising both the price of the coverage and the attachment points.
So they're telling Assurant, you need to bear more of the initial risk before we'll step in.
Exactly. So Assurant is forced to retain a higher dollar amount of the initial loss, and they're paying more for the coverage that sits above that new, higher retention level. This forces Assurant to try and pass those costs on to the consumer through premium increases. The risk is that if regulators, who are focused on affordability, block those necessary rate hikes, Assurant's margins will get compressed even with the reinsurance tower still in place. It's a subtle, creeping risk, but it's one that demands attention because it directly threatens the sustainability of those high global housing margins.
This has been a really rigorous dive into the business model and the structural risks. Let's try to synthesize this complex hybrid company, this logistics platform, this growth engine, this recession hedge into a final valuation assessment.
Valuing AIZ is tricky because you have to integrate two completely different business models: an asset-intensive insurer and a capital-light logistics processor. You can't just use a simple peer comparison. You have to recognize the blended nature of the company.
So relative to its financial peers, where does AIZ land with its 14.7 times PE ratio?
It rightly commands a premium over the pure-play property and casualty insurers like CNA Financial, which usually trade closer to 10 times earnings. That premium reflects the market's acknowledgement of the higher quality, less volatile connected living growth engine, which a pure P&C firm just doesn't have.
But how does it compare to other high-quality specialty firms?
It trades roughly in line with, or maybe slightly below, high-quality specialty financials like American Financial Group, which is also around a 14 PE. And this suggests that the market partially gets the quality story, but it hasn't fully appreciated the depth of the logistics moat.
So what does a deeper intrinsic valuation model suggest about the current price?
When you run discounted cash flow models and you properly normalize them to account for that increasing percentage of fee-based recurring free cash flow, you get a pretty broad intrinsic fair value range of about $253 to $320 per share.
So even at current levels, it looks undervalued.
It implies the stock is modestly undervalued and still offers a decent margin of safety, with the big assumptions being that the T-Mobile partnership stays solid and the connected living growth thesis continues to play out.
So for the long-term critical investor who's looking for a high-quality compounder, what is the final investment verdict here when you put together the structural hedge, the growth, and the capital return?
The verdict for us remains a strong long-term buy. AIZ gives you a unique portfolio stabilizer with the LPI recession hedge. It delivers robust secular growth through the mobile supercycle, and it accelerates shareholder returns with that highly aggressive, reliable, cannibal share buyback strategy. It's a rare blend of defensiveness and compounding power that is very hard to find in a single stock.
And as we close out this deep dive, for the experienced investor who's digested all this complexity, what are the two most crucial ongoing monitoring tasks they need to perform diligently?
Your monitoring tasks have to be focused on those twin structural risks. First, you have to rigorously track the health and the operational entanglement of the T-Mobile partnership. Look for any signs of outsourcing or shifting repair logistics away from Assurant. That's job number one.
And job number two?
You must maintain constant surveillance over the LPI regulatory environment. Any hint of state or federal regulatory proposals about premium caps or mandatory loss ratio minimums requires an immediate reassessment of the entire profitability thesis for global housing. Those are the two tripwires. And before we wrap up, I'll leave you with one final provocative thought to explore on your own as you consider this investment. The market multiple for AIZ is still heavily influenced by traditional financial metrics, things tied to book value, capital requirements, and underwriting risk.
Right, the insurance lens.
The insurance lens. But considering the stability provided by that mobile protection duopoly and the increasing percentage of high-quality capital-light service fee earnings coming from connected living, how much higher should Assurant's valuation multiple actually rise before it is completely re-rated?
Should the market eventually just ignore the book value and the insurance float entirely and instead assign a valuation multiple based purely on that high-quality fee-based earnings stream? Should it be valued more like a proprietary payments processor or a sophisticated logistics platform?
That is the fundamental re-rating question, and it's what defines the long-term opportunity in AIZ.
A fascinating question to end on. We provided the framework and the critical data. The ongoing analysis is now yours.
Indeed.
That was the deep dive on Assurant Inc. We hope this has given you the necessary depth and the framework to move beyond that surface-level assessment and really understand the true mechanics of this counter-cyclical compounder. Thank you for diving deep with us.